Hello, everyone, and welcome to the first episode of the series. And today we're going to be showing my dividend growth portfolio. So, as you can see here, we started off with $1,500 and we're going to be growing this using dividends. So, in this portfolio, I have 30 different holdings. If you see here on the pie preview, I have 30 different holdings and it has an average dividend yield of 4.536%. That was based off of Friday's close, which was April 3rd. So April 3rd of 2020, and we're going to be growing this portfolio strictly using dividends and share price appreciation, but we're mostly going to be focusing on dividends. So in this portfolio, all 30 companies pay dividends. Most of them have pretty high yields, with the exception of just a couple. So in this portfolio, we're not going to be focusing so much on this number. We're going to be focusing on this number. In the coming weeks, in the coming months, we're going to be making more and more deposits. We're going to be purchasing these same companies. We're going to be purchasing different companies, selling those that change their business fundamentally, and we're going to be trying to grow this portfolio, getting as many dividends as possible to get this number as high as possible and to get that dividend to go up. So in this portfolio, you can see that it has 30 companies, and I'm going to just name them off real quick, and I'm sorting from the largest target percentage down to the smallest. So the first one is Broadcom. The next is Realty Income, Visa, Southern Company, Wells Fargo. Then we have Pepsi, McDonald's, 3M, International Business Machines, Whirlpool Corporation, Procter & Gamble, Johnson & Johnson, Mid-America Apartment Communities, Kimberly-Clark, which who knows how much money they'll make with all the toilet paper that's being sold, Coca-Cola, Caterpillar, Microsoft, Waste Management, Discover Financial Services, Altria, Home Depot, Verizon, NextEra Energy Partners, Apple, Dominion Energy, Cisco, JP Morgan Chase, AT&T, Qualcomm, and Foot Locker. So I'm going to be going through these one by one, and I'm going to be describing why I chose them, why I put the percentages that I did on them, why some of them are as high as 8%, why some of them are as low as 2%, and I'm going to be giving my reasons behind that, because it's not just based off of dividend yields. Because, for example, Visa has a very low dividend yield, even though it's very high on the portfolio, but AT&T, for example, pays a much larger dividend, but it has to do with their financial future and what they're doing as a company moving forward. So I'm going to be taking that into account. Okay, so before I dive into my number one company in the portfolio, which is Broadcom, and start going through these one by one down the list, I want to be diving into something that I think is very important. So we're going to be comparing this portfolio over the last 5 years to SPY, which is the ETF, Spider ETF, for the S&P 500. We're going to be looking at that over the long term, over a 5-year span. So if you see here, over 5 years, by the way, these percentages have nothing to do with dividends. This is strictly just share price gains. So if you were to take these companies and just buy them one time 5 years ago at these exact percentages, 8, 7, 6, whatever, you would have 27.28% gain based off of the last trading day that I'm recording this. If you were to do that with the S&P 500, which is obviously the top 500 companies in the world, you'd only have 19.4%. Investing in the S&P 500 is very common. A lot of people will do index investing, and over the course of 5 years, you'll have a 19.4% gain. But in these dividend companies, you would have a 27% gain. Now, obviously, the key here is we're not just looking at share prices. So, as of Friday, that dividend yield is 4.5%. But on the S&P, it's 2.3. So with my portfolio, not only are the share price gains higher, but the dividend yield is almost double. So if you factor that in, this number will far exceed any gains that the S&P 500 would. So if you were to actually take the 5-year span with dividends reinvested, it would be probably double the amount of gains that it would compared to the S&P 500. So that's just something to take into account. I know a lot of people my age tend to primarily focus on things such as growth investing and trying to find the new hot tech company and how it's going to explode in share price in the next 5 years and how it's going to double, triple, or times 10, Tesla. But that's not something I'm focused on. That's not my strategy. So I'm going to be going through these one by one and show you how, even though a lot of them are older, blue chip, boring companies, when you factor in the share price gains with the dividends reinvested, it'll start to look pretty good. So Jump right into it. We're going to be looking at Broadcom. Broadcom is the perfect stock for what I'm looking for because it's the perfect in between to where it has a lot of potential growth for share price in the future, and the dividend yield and the dividend growth is massive. So if we go back 5 years ago, Broadcom paid 40 cents a share in dividends. 40 cents. Today, those same shares pay you $3.25. So that is 8 times, a little over 8 times the amount of dividends that you'd receive per share in a matter of 5 years. The growth in dividends of this company over the past 5 years have been massive. Now, I know at some point that we'll hit a roadblock, that growth will begin to slow down. That is obviously not sustainable. But this dividend will hold. They will continue to increase it. It might slow down a little bit, but over a 5.5% yield is massive. And the best part is they have the number one customer in the world. Their number one customer is Apple. If I go to Yahoo Finance, for those of you that are wondering, this is Yahoo Finance. If I go to the statistics on Broadcom, its forward PE is trading at almost exactly a 10. 10 times the forward price to earnings ratio. That is extremely low, especially for a tech company that is still growing in the single high digits. And how I just said earlier, how their number one customer is Apple. Apple is the number one company in the world. They're the largest by market cap, and they just extended their deal to last into 2023, which will give them an additional $15 billion in revenue. Furthermore, the big concern with dividend investing these days with the illness going around is that a lot of companies will be cutting their dividends. They won't be able to pay them. They're trying to funnel that cash to employees who are losing their jobs. They're trying to keep those people employed. Maybe they're trying to take out loans to pay their dividends or just to keep the company afloat. One thing I like about Broadcom, while they do have a massive yield, they have $6.4 billion in cash just sitting in checking accounts ready to go. That was as of the end of January. They do have a reasonable sized debt. So if you look here, they do have $42 billion. Now the good news about that is that doesn't tell you the whole story. They just purchased another company for tens of billions of dollars, and they're expanding their revenue and their growth as their company, and they're diversifying their portfolio of revenue streams. So this number of 6.4 billion will not stay that way. They're going to continue to raise dividends to shareholders. They're going to begin to lower that debt, as they will in the future, and they'll probably be focusing less on share buybacks and more on dividends, which I, for one, am all for. The next stock on the list is O stock, which is Realty Income. I'm not going to dive into this too far because it would take way too long to describe everything with Realty Income. But basically, to put it in a nutshell, Realty Income is probably the most popular stock for REITs and for dividend investing that I've seen. This is such a popular company. So many people like it. There's a couple different reasons why. The first one is the dividend yield is massive, especially now after the recent crash. 6.4%. That is incredibly high. Incredibly high. And there's a couple reasons why it is so popular. The main one is, so if you look at their profile right here, that is not updated. It says that they have 5,000 properties. Last I checked, it was actually a little over 6,500. This is not updated. They have over 6,500 properties in the US and the UK. And actually, they have properties in every single state. The only state they don't have is Hawaii. And I live in Oklahoma, which is actually one of their largest states. I think it has, don't quote me on that, I think it has somewhere around 500 properties in Oklahoma. But one of the reasons why it's so popular is for a couple different reasons. If you read here, it is listed 250 different tenants. 250 different companies and corporations that have all different types of financial structures and all different types of industries, 47 different industries to be exact, and they are all very high financially graded companies. So for example, their biggest tenant is Walgreens. Walgreens has been around forever. They have billions of dollars on hand. But okay, maybe Walgreens goes under. That makes up only a couple percent of their revenue. If you read here, out of their 47 industries, you read their recent acquisitions have added industrial, office, manufacturing, and distribution properties, which make up 18%. So if you look at these industries that we just mentioned, that makes up less than 1/5 of their revenue. And I gave you the example of Walgreens. Walgreens makes up single digits, a fraction. So even if every single Walgreens overnight was to go bankrupt and default on every single rent payment that they owed, they would still have the mass majority of the revenue. I know they have other tenants such as Home Depot and 7-Eleven and several others. The point I'm trying to make here is that they're extremely diversified. One thing that Realty Income has that no other stock in this portfolio has is monthly dividends. So if we go back to Broadcom and we look every single quarter they pay dividends of $3.25. But when we look at O stock, when we look at Realty Income, every single month they pay dividends of 0.233 cents. So every single month you're getting a check rather than every single quarter. So you can reinvest those dividends faster rather than waiting 3 months. You get it every single month. Every 4 weeks you're getting a check and you can put it right back in your portfolio, back into Realty Income or into other companies. The next stock is one of the only stocks in the portfolio that doesn't have a high yield, that is just strictly focused on share price gains. It has a yield of 0.79%. So when you look at the stock, and I'm telling you about dividend growth investing, 0.8% is so small. It is not anything that is anything worth writing home about. For every share, you get $1.20 a year in dividends. While it is poor, there's a couple reasons why I own Visa. The first one is I am very, very, very bullish on the long term on Visa. The 5-year performance is about 133% over the course of the last 5 years. I think another 5 years from now, we will see that again, if not more. If you go back to 5 years ago, they were only paying 12 cents a quarter dividends. Now they're paying all the way up to 30, so which is about 2.5 times what it was 5 years ago. Huge dividend growth. The PE ratio is a little high, but the main thing that I think about here is I'm going to tell you one statistic about Visa that will probably ease your mind a little bit if you're curious as to whether or not they'll keep up with this growth. 85% of the world's financial transactions are done strictly in cash. 85%. So only 15% of the transactions that we do every single day in the entire world are done through credit and debit cards and online and things like that. So think about the potential growth here, especially in the international markets. So I think as my generation, as the millennials grow up and Gen Z come into the workforce in the coming decades, they use credit and debit cards far more than the baby boomer generation. So every single day, these high school graduates, these college graduates, whatever, are getting credit cards and debit cards with their new jobs straight out of school, and they're going to be using those for the rest of their lives. Furthermore, the main growth here is the international markets. The international markets, so look, it says Visa operates in 200 countries and processes in over 160 currencies. As those developing countries and some of the poor developing areas start getting credit and debit card machines and start doing online transactions through mobile apps and things like that. They just recently acquired a company called Plaid, by the way. As soon as that starts happening, they're going to be following suit with America. So every single day, this company is growing massively. Their dividend is following suit as well. So if you look at their last quarter, the last time the dividend was raised by Visa, it was raised from 30 cents all the way up to, from 25 cents all the way up to 30 cents. So if you just take that and divide that by 25, that means that it was raised 20%. 20% annually. That is massive. And I think in the long term, it has just as much growth ahead of it. Southern Company, this is a really boring company. Not a lot changes here. It's pretty much going to stay the same, so I'm not going to take too long to describe this one. They're a utility company. As you read here, they distribute electricity and natural gas to approximately 9 million customers in 9 states. And it shows some of the states down here. Their dividend yield is about 5%. Now, when you think about things that are going on now with the illness and people losing their jobs and things like that, could you argue that someone is, for example, not going to go out and buy a new vehicle or buy a new house or spend money on dining out when they're losing their jobs, they're lowering their income, things such as that? Yes, you could absolutely argue that. People are not going out and buying new vehicles. Mortgage rates are absolutely plummeting. But is everyone going to pay their electricity bill? That is a need. That is a necessity. I think a lot of people would choose to pay their electricity bill before they would go out and pay for a movie theater ticket or to buy a new fancy upgrade on their vehicle. So when you think about the Southern Company, it is a need-based company. You're not going to stop using electricity because of the illness that is going around. Because the stock market crash, you are not going to not pay your electricity bill. If you can't pay your electricity bill, it's because you probably can't afford to eat and you need help. The point I'm trying to make here is your utilities are a primary use. You can't avoid it. So the Southern Company is a very boring, stable company. They're government regulated. They slowly grow that dividend every single year, and the share price gains follow. It's one of the most, I don't want to say guaranteed, but it's about as safe as an investment as you can make, and I'll see future returns in that. So the next stock that we're going to be going over is Wells Fargo. This stock has obviously received a lot of heat in the last couple of years with the whole scandal that happened and everything. And it's really one that I wanted to avoid for a long time until recently. So they actually canceled all their share buybacks, just like most of the major banks has. And if you look at their dividend yield, almost a 8% yield, 7.78%. For a bank, especially one of this size, that is absolutely massive. That is astronomically big. So if you look at their dividend yield, it's 7.78%. It yields almost 8% just to own it. That is massive. They just canceled all their share buybacks. This is a bank. This is one of the largest banks in the world. They're super, super old. They have over 260,000 employees. We all know who Wells Fargo is. They deal with financial services. So I think over time, as we get further and further down the line, all the bad news around this company regarding the scandal, I think we'll see that slowly start to fade away, and I think this will get back to the bank that it used to be. So if we go to our next company here, the next one on the list is PepsiCo. So one thing I love about PepsiCo is, first of all, I'm a huge Doritos and Mountain Dew fan, but PepsiCo has so many drink and food brands that are so, look, you can see down here it just has some of the major ones: Pepsi, Mountain Dew, Gatorade, Doritos, Lay's, and Ruffles. There's so many others. If you go to their investor relations, I would say they probably have somewhere around 50 brands, uh, including deals with Starbucks. And actually, one thing that is actually very recent with Pepsi, I would say about a month and a half before the time I'm filming this, they actually just bought out Monster. Energy drinks, and Monster specifically, have been growing very rapidly. It's much like the sparkling water section. It has been growing so fast. Actually, Coca-Cola, which is also one of my investments, just came out with its own sparkling water brand called HAA. Aha! Yes, I'm serious. That's the name of the brand. Pepsi just bought out Monster just to have one more brand in its portfolio, just to get one more income stream. And actually, one thing I just noticed, the next dividend payment come June, they'll actually be raising their dividend again. They've been raising their dividend, I think it's 40 something years in a row now. PepsiCo, food and beverages, such as the one named down here, and they have so many other brands like Quaker Oats and stuff like that. That just people are going to buy them regardless of whether or not they are in a recession or not. McDonald's. Okay, McDonald's is one of my larger investments. One of the things I like about McDonald's is, before I go any further, I want to point something out here. If you look through my portfolio of the 30 companies, these two are included in that, so is Realty Income, so this will be the third one so far. Of the 30, you'll see that 14 of these stocks are dividend aristocrats. So if you don't know what a dividend aristocrat is, they have not paid, but they have raised. That's the key word here. They have raised their dividend at least once consecutively for a minimum of 25 years. So that means for the past 25 years, they have raised their dividends at least once, minimum of 25 years. Some of these, like McDonald's and PepsiCo, are 30, 40. 3M, to be specific, I think is 62 years off the top of my head. So if we go through here, I have Realty Income, Pepsi, McDonald's, 3M, IBM, Procter & Gamble, Johnson & Johnson, Kimberly-Clark, Coca-Cola, Caterpillar, which is a new one, Altria, Home Depot, not Apple, Cisco, and I believe that's it. Oh, and AT&T. AT&T have all raised their dividends for 25 years minimum. So anyways, one of the reasons why I put McDonald's on one of the higher percentages in the portfolio is that it is about the most recession-proof stock that you can get. So in a lot of scenarios, if you have a business and a recession happens, sales begin to decrease. Well, with McDonald's, it's actually on the flip side. This illness that is going around is a bit unique compared to most situations. But if you go to 2009, the stock actually rose. So when people lose their jobs, instead of going out to something, say, like a Red Lobster to pay $30, $40 a plate, they don't have money. They just lost their jobs. Maybe they got cut back on hours. They can't afford their mortgage payment. So they're trying to save as much money as possible. That is including their food bill. Where are they going to go? Well, they're probably going to go to one of the cheapest, most common fast food joints there is on the planet, and that is old McDonald's. This is a very heavily invested company by Warren Buffett, and this is a stock that I could see myself holding potentially for life. The only way I would really sell this company is if the share price gain just shot up to something so ridiculous that it was absolutely insane. The dividend yield isn't amazingly high. It's over 3%, but that's enough for me. The dividend growth is very good. 5 years ago, it paid 85 cents. Now it's all the way up to $1.25, and they have a lot more room to grow that. So if we go to the next stock, the next one here is 3M. This is a company that I like a lot. One of the things I don't like about them is that in situations like this, when we're going through a recession, they are hit pretty hard. But that said, one of the things I really like about 3M is this is by far the most diversified company I have ever seen. They are a conglomerate of products. So if you see here, it says 55,000. I believe that's outdated. Yeah, so as of 2019, I believe now they're up to 56,000. But as of 2019, they have 55,000 products. Think about that for a second. 55,000 products. I can't even name to you 1% of these companies' products. I try to research it on their website. Just off the top of my head, I can try to name some things such as post-it notes to scotch tape to electrical wiring to insulation in houses. I know they deal with ink cartridges for printers, a bunch of automobile parts. There's so many different segments that this company is involved in. It's hard to even keep track of it all. So mostly you just have to focus on the company as a whole and see the type of growth and things like that. But the main thing to focus on here is they're so diversified. They've been around since 1902. The good part about this is if of these 55,000, if 1,000 of their products go to crap and they just stop selling them, and maybe they even have to renovate them, push them back, they don't get any sales, maybe they have to shift segments and promoting them and advertising them, whatever, they have 50,000 more products behind them. If one fails, another one succeeds and it makes up for that loss. For most conglomerates, it's really erratic and it doesn't work for a lot of companies, especially these days, but for 3M it does. They've been around since 1902. That's 118 years. They're not going away anytime soon. Their dividend yield is 4.4%, and that's one of the highest this stock has been in decades. So you're not going to see a dividend like that on 3M very often unless we're in a recession. So I want to take advantage of that now while we have the chance. So the next stock on the list is International Business Machines. One thing about IBM, it has been really hit hard in share price over the last 5 years. I don't think it's really been given justice. I understand why. It's pretty much just stayed flat until the recession that has begun to hit us. But they recently purchased Red Hat. What they're trying to do, they're trying to get market share in cloud space. So they're going to be competing with another one of my investments, such as Microsoft, with Azure. And their purchase with Red Hat is going to be cross-selling a bunch of their platforms. Now the thing is, a lot of IBM's customers, it's very sticky and they have so many different tech products. I'm not going to go one by one trying to describe them, but basically they're currently shifting their business model and changing things to make it more profitable and get that revenue growth back up. But in the meantime, while they're changing that, while their CEO and their board and all that is changing that business model, they currently have a dividend yield of about 6.1%. That is incredibly high, especially for a very, very old company such as this. And they're going to be around for a long time, at least that's what I believe. Their debt is not absolutely out of control with the purchase of Red Hat. And I think in the long run, they're going to come out of this better than ever. So, far as buying now and holding on a long-term perspective, 1, 3, 5, 10 years out, whatever, I think a lot of dividends are going to be made, and they're another dividend aristocrat. And so just 5 years ago they're paying $1.30. Now it's up to $1.32. So oh yeah, and I believe they're due for another raise come May. So yeah, I'll be ready for that as well. So next company on the list we're going to be going through is Whirlpool. Whirlpool is really a company that I feel like is not very popular and I don't see people talk about very often. Basically, if you've ever had an old solid white washer and dryer or refrigerator, it's probably come from Whirlpool. Their financials are very stable for a company of their size. I think they're very undervalued, and they do have pretty stable dividend growth. As you can see here, 5 years ago, they're paying 90 cents. They're all the way up to $1.20, and they're going to keep growing that. And they're pretty well set for the recession, I'd say. They have quite a bit of cash on hand, and appliances are one of those things, it's pretty need based. If your washer and dryer goes out, you're not really going to wait for that unless it's absolute necessity that you can, because that's pretty much things that people need: dishwashers, refrigerators, things like that. Next is Procter and Gamble. They sell a lot of different things, such as like shampoos and things like that, Charmin toilet paper, diapers, just a lot of consumer staples and things like that. Things that people buy every single day and they don't really have a choice for because it's need based. Procter and Gamble is incredibly old, as you can see here, 1837, almost a 200-year-old company, one of the oldest companies in the stock market. Has a dividend yield that is a bit lower than the rest, but one of the reasons why I'm investing in Procter and Gamble, well, you heard it here. It's almost 200 years old, and the dividend growth, it's not going to stop its dividends payments. It is very high investment grade company. They have very good financials, and they're not going to stop raising that dividend anytime soon. So Procter and Gamble, a very old, safe company, and I don't have any worries with them including. And speaking of old and very safe companies, let's take a look at Johnson & Johnson. So, one of the largest healthcare companies in the world, selling anything from surgery equipment all the way down to common Star Wars band-aids. They raise their dividend every single year. 5 years ago, it was 75 cents, and now it's all the way up to 95 cents. They're also due for a dividend raise come May. Yay. So, their dividend yield is pretty much the same story as Johnson & Johnson. They just sell different products in a different category. About 3%, a little under, but it's really safe. And actually, one cool thing about Johnson & Johnson, there are only two companies in the entire S&P 500 that have a triple A credit rating. And you're looking at one of them. It's Johnson & Johnson and Microsoft. They have a credit rating that is higher than that of the government's. So this means that if you invest in a bond or a stock trying to get dividends back from Johnson & Johnson, you are more likely to get your money back from Johnson & Johnson or Microsoft than you would be the U.S. government. That's pretty crazy. You don't see that very often, and it's very hard to get a AAA rating, but there's one of them. The next is Mid-America Apartment Communities. One thing about this stock is that they have a 4.2.5% yield. This is another one of the REITs I have in this sector. This REIT primarily focuses on just good old-fashioned apartments. I know their largest state is Florida. That's where they have the most of their locations, but they also have holdings in Texas, North Carolina, and there's some other states in here not mentioned as well. And I just really like it because it's really stable as rents get higher and they keep on expanding. They're kind of a smaller REIT, $10 billion. They kind of, I guess say kind of mid-size. As they keep on purchasing new properties and keep on investing, they're going to keep on raising that dividend. And well, people are always going to need a home to live in. A lot of these companies, you can tell, are very need-based. Okay, Kimberly-Clark. Okay, so with the illness that is going on, with everybody freaking out, buying every roll of toilet paper that has ever existed, Kimberly-Clark is the one to gain from that. They're the world's largest company for paper towels and toilet paper and things like that. You see they have Kleenex, Cottonelle, Pull-Ups, Huggies, stuff like that. They're also a dividend aristocrat. 5 years ago, they were paying 88 cents. They're all the way up to $1.07 now. They just raised their dividend this quarter. Another need-based product. People are always going to need toilet paper and Huggies for diapers and things like that. Coca-Cola, pretty much the same deal as Pepsi. The only thing I don't like about Coca-Cola compared to Pepsi is that they only sell beverages. They do not sell any food-based products. So one thing I like about Pepsi compared to Coca-Cola is that it has that over it. And also, honestly, I just like their valuation a little bit better on Pepsi versus Coca-Cola. So that's why I made it bigger. But yeah, you all know Coca-Cola. Pretty much every restaurant you'll ever go into has their beverages. Caterpillar. So Caterpillar is a bit more sensitive to economic times, recessions such as this. They do have pretty good dividend growth from 70 cents 5 years ago all the way up to $1.03. That will continue to grow, and even this year they had quite a substantial dividend raise from 86 cents up to $1.03. So Caterpillar, they make things such as bulldozers and excavators and things like that. And Caterpillar is very heavily invested in the oil sector right now. And that's one thing that I am a little bit worried about. And especially as people might be having less infrastructure and things like that with the economy going down. That is one thing I am worried about. But they have raised their dividend for 25 years in a row and they are financially stable. They do have a lot of cash on hand. I think the whole shutdown is not going to last very long, and I think when they'll get past this, just like all of these companies. I don't think the shutdown will last past April. I don't think we can handle it. I don't think that the government will allow it to go past April. So the next stock is Microsoft. Microsoft, another one of the AAA companies that I mentioned here. Microsoft is a very rapidly growing company in the last 2 years or so, 3 years. Their dividend is very poor. They're one of the lower yielding dividends in the stock portfolio. That said, Azure and their cloud space, they have such a bright future ahead. This is one of the things that I'm buying. This is one of the stocks that I'm buying just strictly for the share price gains and the dividend growth. The yield is nothing to write home about. This is one of the few, like a Visa, where I'm buying just for the share price gains and the dividend growth. So if you look here, that I was paying 31 cents 5 years ago. Now it's all the way up to 51. They'll continue to grow that very rapidly. Microsoft is a very old tech company, and they're going to continue to do that growth. Waste management is one of my favorite stocks in the entire portfolio. People are always going to create trash. That's not going away. 2.5% dividend yield. It's one of the largest investments by Bill Gates, one of the richest men on earth. It's went from 39 cents all the way up to 55 cents in the last 5 years. People are going to continue to create trash regardless of what the economy is like. People are always going to make trash, and waste management is there to clean it up. They've also done some things such as like taking their trucks to natural gas to try to save on bills for like fuel and things like that before gas was incredibly cheap. And yeah, that's one of the safest business models there is. Trash is not going away anywhere, and they have a lot of sticky customers that stay with them probably for decades. Discover Financial Services, I think, is really undervalued. PE ratio of 3.4. Wow, that is insane. Discover Financial Services, just like a Wells Fargo or a JP Morgan, whatever, handles financial transactions and their dividend yield is massive. They have also suspended their share buybacks and they're just going to be focusing on dividends and getting all their loans out to try to help the economy. Next is Altria Group. One thing about Altria that I don't like is that they are primarily focused on tobacco. I'm not a smoker or anything like that, but the dividend yield is 9%. That is so incredibly large. Selling cigarettes and tobacco products and cigars, things like that. People who smoke get addicted and I was talking about sticky customers earlier. People who smoke usually smoke for life or for several years and buy cigarettes every single day or every single week. Altria is going to take advantage of that and they're going to continue to get revenue from those customers. While I don't really promote smoking, I like their stock and I like their company. And I'm going to continue to hold them and get that huge dividend yield. The next is Home Depot. Home Depot is another dividend aristocrat. Home builders and people working on their homes, things like that. Over the next 5 years, 59 cents all the way to $1.50. I think that is going to continue to happen. So you look, that's almost 3 times what it was 5 years ago. I think that growth is going to continue. They have a dividend yield of 3.3%. And I think they have a really low payout ratio, and I don't think that's going to stop anytime soon. The population is going to keep growing, and people are going to keep on building more and more houses. So I don't really think that's going to stop. Verizon. Verizon is very similar to AT&T. is in regards to how I believe in them in the future with the company. They're one of the main competitors for cell phone providers. You all know Verizon, 55 cents up to 62 cents today. But the dividend yield is very high, and basically I wanted to diversify. I really wanted to focus on AT&T, but I wanted to split into Verizon as well so I could diversify that evenly so I could have a little bit of a competitor because AT&T is a bit more risky, but I wanted to get kind of diversified between the two telecommunications company. Next is Next Era Energy Partners. They're primarily focused on renewable energy. So the reason why I like them is that renewable energy is the future. That is what I believe. They're primarily focused on wind and solar power. In the future, as global warming begins to take more and more of effect and we continually go closer and closer to strictly solar power and wind power and things like that, Next Era Energy Partners is going to be on the front lines of that. And they do have solid dividend growth and a dividend yield, 5.65%. And I'll be taking advantage of that dividend. Next is Apple, kind of a similar play to Microsoft. They have a 1.3% dividend yield. They have dividends starting at 52 cents and it's all the way up to 77 cents now. That's going to continue to go up. They have so much growth ahead of them. So I'm going to be investing in Apple primarily for the share price gains and the dividend growth while the yield is low. Dominion Energy, same thing pretty much as Southern Company. It's a utility company, very boring, very safe. Energy company providing electricity to thousands of different people. And yeah, solid dividend growth, as you can see here, just steadily goes up, and the government regulates them and allows them to raise prices every now and then. Cisco is one of the ones I would say is a bit more risky as far as dividends go with this recession. They do not have a ton of cash on hand. That said, I see an opportunity. If they're able to pay that dividend and make it out of this recession alive, this will be a very, very solid company for future. They provide so much food. So as you see here, they're the largest U.S. food service distributor, boasting 16% market share of the highly fragmented food service distribution industry. Cisco distributes over 400,000 food and non-food products to restaurants. That is incredible. They're the largest distributor of food and non-food products in the US. So Cisco buying at these prices, considering that it was a $85, $86 stock just 3-4 months ago, buying it today under 40 is ridiculous. So if that dividend is able to hold, I would love that. I really hope they're able to hold it. This is one of the few that I think is at a pretty good risk of cutting it. That said, I think they'll probably be able to hold it out. I don't think this shutdown will last as long as people are thinking. JP Morgan, same situation pretty much as Wells Fargo without all the accusations and scandals, raising it from 44 cents up to 90 cents. As they recovered from the financial crisis, they're getting that dividend more steady, 4.28%. I think that financials and banks in general are really undervalued, just generally speaking, and I think they'll recover from this recession just fine as they always do. AT&T, I'm not going to go too long into this. This is one of the highest yield stocks in the portfolio at 7.58%. Pretty much the same deal as Verizon as discussed earlier. Telecommunications company, and they're trying to expand their business and to focusing more on dividends and paying down their debts rather than focusing on share buybacks, which I am all for. Okay, the last two are Qualcomm and Foot Locker. So if you look at Qualcomm here, the share price gains are a little bit flat. And the reason why I got Qualcomm on my radar, once again, they have the #1 largest company in the world as their partner, Apple. As you can see here, this little 3, 4, 5 day span, whatever, when they shot up significantly, that was when they announced the partnership with Apple. They are the #1 players in regards to 5G. Broadcom is another massive player with 5G. As you can see here, it's even talking in the description. The firm is poised to be a leader in 5G as well. Yes, 5G is going to be massive, and Qualcomm is going to be in the front rows with that, with their microchips and things like that. It's going to be massive. I think the share price gains are going to be huge. I think the dividend, which is already 3.8%, will be significantly higher than that in 5 years from now. 62 cents. I think it'll be well into the $1, $2, $3 range, and I'll be there to take advantage of it. Okay, the last one is Foot Locker. And of every one in this stock, if I had to pick one that I say I wouldn't be holding extremely long term, as in 5, 10, 15 years, anything like that, this is the stock that I would be selling the quickest. So Foot Locker has a dividend yield of 8.73%. The PE ratio is only 4.4. Market cap is now under $2 billion. Wow, that is incredible. 5 years ago, or we go back to 2016, at one point the stock was even $77, $78. It is now under 20. It is $18.32 a share. Dividends have went from 25 cents all the way up to, actually it's about to be 40 cents. They have a dividend payment coming up in a couple of days. And I would say on a valuation standpoint, this is the last stock I'm going to show, Foot Locker, on a valuation standpoint, is one of the best valued companies I can find in the portfolio. The only reason why I wouldn't hold them long term is in 10, 15 years. They are a brick and mortar store, and I don't know how their future holds with shopping malls being in question. They have a forward PE of 4.09. And if you look at their payout ratio, only a third of their profits are paid out to shareholders. And the main thing you want to look at here is, will they cut their dividend? Regardless of how long this illness lasts, maybe we're shut down for a week, maybe we're shut down for 6 months, they have 900 million, this is all in thousands of course, they have $900 million in cash. Okay, we were probably saying, what is their debt? Do they have some massive debt, I'm assuming? No. They have 100 million in debt. So they could pay off every dime of their debt tomorrow and still have about 800 billion in cash just sitting around, ready to go. This stock is extremely undervalued. Anytime a stock is trading at a PE of 4, it's priced for bankruptcy. If you go to their book value per share, for those of you who don't know, book value per share basically means if the stock was to declare bankruptcy tomorrow with any company and you were to sell all of their assets just for cash, what would the stock price be worth? So basically, if they were to sell their entire company tomorrow, it would be worth about $23 a share. Bankrupt. This is 18. If you don't believe that Foot Locker is going bankrupt in the next 5 years, I wouldn't see a reason not to own it, especially with a dividend yield that is paying almost 9%. You're almost making 9% a year just to own it. And they just raised it. They just raised their dividend, and they're about to raise it more. So there's not really any reason I can see not to own it between now and the next couple of years. But anyways, guys, thank you so much for going through my portfolio. Week by week, we're going to be making deposits into this, and I'm going to be updating you on my portfolio performance as well as news going on in the market. So I appreciate you guys that did make it all the way to the end of this video. Make sure to smash the like button, hit the thumbs up, share this with anybody you know, and for those of you that are wanting to comment on the video, any comments down below that ask me questions about these stocks specifically, ask me if you'd like to review a stock, ask me questions about the market, I'll be putting you in the video and I'll review your question and answer it as best as I can. So thank you guys so much for watching, and until next time.